will have to leave at about 11:15, and it looks like we've got a fairly hefty agenda. So if I have to leave before we're finished, I'll ask if Susan Lamb would take over the chair. Okay. Thank you. Welcome, everyone. So the first item on our agenda is the April 28th regular meeting and the June 18th special meeting minutes. So I would like to ask for a motion and a second.
So moved.
Thank you.
Second.
Thank you. Now, are there any corrections or additions to either set of minutes? No? All right, all those, if you're a voting member, I need your hand and your face with your vote. All those in favor say aye. Aye. Well, I see okay, let's do this differently. Do an aye and hand.
Aye.
Aye.
All right. Is anyone opposed? All right, thank you. Those both pass. The next thing we have on page 6 of your packet is the fourth quarter financials, the expenses, and that is for your information only. I don't know if you all have any questions about that. It's fairly straightforward, but we do not need to approve that. So we will move right on to the ratification of the transfer of payroll, estimated payroll for July 2026 through September 2026. And this will need a motion and a second.
Move to approve.
There goes second.
Okay, very good. Are there any questions? Anything at all? This is fairly straightforward. So all those in favor, please say aye. Aye.
Aye.
Aye. Is anyone opposed? All right, that motion passes. Thank you. On page 8, you will find the sad news, which I think we all knew previously, but to be sure you know that Gay Lang, a member of our pension board, passed away May 11th. And this is very interesting because her husband passed less than a month later. And so, I think we approve the funeral benefits. Is that correct, Samantha or Susan? Is Susan on here?
I am here.
Yeah, is that the
Yes.
main thing that we're supposed to approve for her? Because she, when she passed, we needed to approve the spousal annuity, correct?
Yes. Yes, ma'am.
And do we need to do that for the short period of time that Vic received the annuity, or how do we work that?
Yes, because he received the June annuity because he,
Okay,
so yes, so we do need to approve the annuity as well as the funeral benefit.
okay. And can we do that in one motion, I think?
Yes, ma'am.
Okay. So I'll entertain a motion and a second to approve
So
both
moved.
of those. Thank you. Is there a
Second.
second?
Second.
All right, thank you very much. Are there any questions or comments? All right, all those in favor, say aye.
Aye.
Is anyone opposed? All right, thank you very much. That passes. And now I'd like to turn it over to Samantha about our next issue, which is that we need to initiate the special election. if
That's
you'll
correct.
explain that. We haven't had one for a little while.
Yeah,
Will you go-
so, yeah, thank you, Mayor. We need to do a special election since this is in the middle of a term. Ms. Lang's term would have ended in December. So I know it's late in the year and this is going to get us going for a short period, but I've got nomination ballots ready to be mailed out after this meeting. So the board does need to approve a special election. The regular one will happen at the end of the year. It doesn't need approval. So at this point on the nomination form, I'm saying that the term will be from September to December. At this point, we'll meet in October to approve whatever happens, but just so we can get that on.
Mhm.
And then just a refresher, if we do end up this way, I'm going to send the nomination to retirees and beneficiaries, open it up to both of them at the same time since we're pressed on time for this one. If we don't have any responses, that will kick into our new process that we did a couple years ago, where it kicks it to your office, Mayor, for appointment through the regular boards and commissions process.
Mhm. And when do they have to have you send the letter? When do they have to notify you? What's the deadline if they want to serve?
I'm giving a 2-week deadline. So with the since is all done by mail, I'm planning to have
Mhm.
everything mailed out by today or tomorrow. They have 2 weeks from today, so I believe I have it set that they need to have their nominations sent back to me postmarked by the 11th. I have a ballot, a skeleton, that if
Mhm.
any names are given, I will put it on and have those mailed out the next day or two, and that will be turned in on August 25th. And that is why I chose the September through December term.
Okay, does anyone have any questions about the process or what we're doing here?
Mayor, I was going to ask the question. I saw in the minutes for the June special meeting that you had asked the question about the number of retirees or the number of members, participants in the pension, and it was
Yes.
23. My question for Ms. Combs is it now 21 or was 23 after Mrs. after Gay and Vic passed away?
We have 21.
Hmm,
Okay,
okay,
thank
that's
you.
a good question to keep us updated on that. Are there other questions or
Samantha,
anything
do we
about?
just, yes, Mayor, I do. Sorry. Samantha, do we just send that regular mail or is
Ye-
there? Okay,
Yes,
I'm just wondering, because if it's only a 2-week turnaround, there's no telling when they might actually get the mail. So I don't know if that's a
Generally,
consideration we might need to make in the future.
yeah, I'm open for that. Generally, we've done a 2, maybe 3 week with the special election. We don't tend to get a lot of responses, no matter the deadline. But we do send in I get postage paid on envelopes, and I include that in there with it so that they just have to put it back in their mailbox to kind of shorten that time as well.
Okay.
I know what you mean, Councilmember Baxter.
Well, when
I
everything
know-
goes to Louisville, you never
Well,
you never
I know of someone recently who sent an invitation a month ahead of an event, and it got there 2 weeks after the event. This was just personal mail, so I think it just is dicey. So what's your pleasure? Do you want to extend it or leave it the way that Samantha has explained, or?
I mean, I think we need to get it done as soon as possible. I just, in
Yeah.
the future, we may need to think about sending it a faster, like a higher postage level.
Okay. Yep. Anything else? about this process? Yes.
I will say, Councilmember Baxter, I appreciate your comments because we deal with it every day over here with our motor vehicle registrations and election with ballots. And I mean, it's the most frustrating thing in the whole wide world. And even if you pay a higher postage, I'm not sure you get a different service. So
Mhm.
just saying in a very kind and respectful way. But you know, I think that I saw when you were saying 2 weeks, I had the very same thought, because if it goes to Louisville, we've actually talked to the postal service about it. If they come and pick up our mail out here in front, it goes to their Nandino that day, and then it might get taken to Louisville the next day, but it could be the following day, and then they have to process it in Louisville, and who knows when it comes back. Could be another week or so. We've had to extend our timeline that we will give a free registration if they haven't received it to almost 3 weeks now, because it's really bad. So, but I think given the factor that the last election that was taken with the city employee pension fund members didn't avail anyone, and the mayor ended up having to appoint, I think 2 weeks probably would be sizable, you know, acceptable in this situation, because
Mhm.
I doubt anything's going to change there. So I hope it
Well,
does, but
and it's good to know that you include um, an already stamped addressed envelope with it. That does help a little
Mhm.
bit, I think. So, any other questions before we move on?
I would just like to add clarity that I looked at the ordinance, and for the regular election, the guidelines are the nomination ballots have to be sent by October 1st. I have to confirm with nominees no later than November 1st. And then by November 25th, to make due for the Thanksgiving holiday, is when ballots need to be mailed out. So we do
Mhm.
have a wider berth when it comes to a regular election.
If we have to, I believe we have to follow that. I'm just thinking if we get a person who will serve the rest of the term, I wonder if we can just kind of encourage them to keep, you know, we'll need somebody after January, right?
Yeah. If I get
For another term.
nominees, I will definitely give that information to them to make do and
Mhm.
encourage them to stay on.
Right. Okay, good. All right. Anything
And
else on
Mayor,
this?
just an update.
Mhm.
Just an update. We only have 3 people that don't live in Lexington. So the majority of all the retirees and widows do live in Lexington for the city group.
Okay. All right. Thank you for that. Anything else? All right. Thank you very much, Samantha. Before we go on to our next items, I would just like for the record to express our deep sympathy to Gay and Victor's families, because she has served quite a while on our pension board and was a faithful member. And of course, you know, this is all related to service to our city way back. So I just would like to express our deepest sympathies to the families. Now that brings us to some hard work, which is the first item is consideration and discussion, which we started we've done every year, which is benefits for our retirees and beneficiaries. We have a history of several years of kind of following urban county government's pay increases. We don't have to, but we like to be sure that our beneficiaries and retirees certainly have a pension that works. And so I'd like to see if we have some discussion about this. The ordinance is in here on page 9, which is for our non-sworn and retirees base annuity and annuity paid to the retiree's widow or resident children, dependent children. So, any thoughts about this? Any motions? What do y'all think?
I mean, I think
takes,
it's a great thing, but
Yeah.
I think we definitely have the money to do it. We should uh, move forward with the 3% increase.
okay.
And I'm
do you-
happy to make a motion if there's.
Okay, why don't you go ahead and do that and then we'll
Okay,
discuss it.
I'll make the motion to increase the pay by 3%.
I'll
I'll
second it.
second it. That's fine.
Okay, Councilmember Savigny, seconded. Now let's have a little discussion. Is there a little discussion or are you mostly good with this?
I just have a quick question. Have we
Yes.
always done that, or have we ever missed a time where we did not do that? I'm just curious.
I believe our history is that we only recently, at least um, in my service, regularly have done it. I don't know about before that. Susan, do you know? I think it was more sporadic.
I
I don't think, I know that you're guaranteed a COLA raise per the ordinances, but we've started doing the additional percentages, I think probably in 2014, maybe.
Okay.
But yeah, it's been consistent for the last several years, but not
Mhm.
prior to that.
Yeah.
I
Yeah.
think, oh, go ahead. Sorry, Councilmember Savigny.
No, I just wanted to make sure that, like, if we hadn't done it for 10 years,
Mhm.
like, there's a reason to kind of look back then and just say, we do have the money and, it could be more substantial, but it seems like it's reasonable. So
Mhm.
that's it.
Okay. All right. Madam County Clerk.
I mean, in the ordinance that's attached to our packet, it talks about the annual cost of living increase of 3%. That says beginning in July of 1 of 92. So, and then I know that we added this other stipend and supplement. And then I saw where it goes through on subsection 9, it goes through 2025. So reading this ordinance, this actually is picking up to be effective January 1 of 2026. Is there, I guess approving it on an annual basis versus going ahead and adding in consecutive years following is based on the number of persons in the plan now? Is that, or is there a benefit to go ahead and have it extended out for a few more years? Because it looks like in the ordinance that's attached, it was in the first pay period following January of 1, 2020, and then 22, 23, 24, and 25 in the subsections, they were all granted the increase of different amounts at the time on each of those years. Is there a benefit to have the ordinance go ahead and have it not just for 1 year, but to have it consecutive for a few consecutive years again? I don't know. I didn't do the homework of going back and looking at an ordinance.
I think one thing is that we do it based on what the urban county government employees receive, don't we? Is that correct, Aaron?
Yeah, Mayor, in my tenure, we have tied the increase to the non-sworn increase for
Mhm.
urban county government, which was 2% this year. Which 3 is perfectly fine, but just to keep in mind why we have had those differences across the years, it's because they have correlated, at least in my tenure, it's because they've correlated to the urban county government's active employee budgets. And the January start date has to do with us altering the annuity payments, if I'm not mistaken, for other benefit criteria that may have to do with Social Security or other things that we may be changing. So the thought was to keep them on a calendar year as opposed to a fiscal year, trying to do retro payments depending on when our meetings fell. So I think those were kind of the thoughts in line with those 2 components that came up in the questions that were brought forward.
Mhm. Okay, thank you for that clarification. Other comments?
Nope.
So
Wrong
the
button.
ordinance 74, 2025 that's in our packet, that is effective January 1, 2026. So am I reading it correctly that that is for this calendar year 2026? So what
It
we're
is.
talking about today then would it be for calendar year
27.
27? Okay, I think that's a good clarification there because
Yes.
I did not, that wasn't resonating with me at the minute. So I would definitely support a 3% for 2027. So
I think correct me, Samantha or Aaron, in the past, what we have done is the council's passed the budget starting on July the 1st.
Yes.
And then we look at what we want to do with the pension, the retirees and the beneficiaries.
Right.
And so we know what we've done with our non-sworn employees. Am I remembering that correctly?
Yeah, and this board just kind of meets in the in-between, so we're ahead of the game to do it for January, and since this
Yeah.
one covers for the calendar year through the
Yes.
end of December, then whenever we're going ahead and making this decision now for January, our payroll folks can go ahead and get that implemented and work with human resources to get those pieces in place.
Does that make sense to everybody? Are there any other comments? All right, I'll entertain a motion. Do we already
There's
have
a motion on the floor,
You
Mayor.
made the motion, didn't
Yes,
you?
ma'am.
Councilmember Baxter. All right, if there's no other discussion, all those in favor, please say aye. Aye.
I
Is anyone opposed? All right, that motion
I-
passes.
If I may, Mayor, I want to confirm that that is for 3%. That was the original motion. And then
Mhm.
I didn't catch the movers for the special election initiation. If we,
Oh, that
that's correct.
was,
Yes.
who made the motion? I think it
We-
was Susan and Dave. Did you tie for
Yeah.
something? And one of
Yeah, I
you,
think-
Dave, did you?
I think
That-
I tied for the second.
Yeah. Yeah.
Maybe. I don't know.
That was for the consideration of the benefit.
yes, that's what I have.
But I
That's
think she needs one for the
the
special election. And
I'll-
also move that.
Yeah, I'll just move it again if you want, just for
Again,
clarity.
yeah.
So I'll move
Mhm.
for the special election.
Mm-hmm. And
Second.
who seconded? Did
I
you?
Well,
seconded
Susan,
that better.
Susan.
second.
Yeah, I think you did. Does
All
that
right, thank you
clean
all.
up your minutes?
And if you'd like
Yeah.
us to vote again, we can, but
It was a unanimous yes.
yes.
Yeah. Thank you all.
Okay, now, thank you for that. It's really a great thing that we can do this for the beneficiaries and the retirees so that they can get a little bump. Okay, now we've got our continuing discussion of the asset allocation and the quarterly investment review. And we have Allison Corbley with us, and we have David Calvert with us, and we welcome you. I
Thank you,
presume
Mayor.
you enjoy doing this by Zoom, but we always liked seeing you in person anyway.
I think we'd like to have it in person if there's an opportunity to do that. I think it's important to have that, in-person conversation.
All right, we'll look at that,
Yeah.
the future. Okay, which of you wants to go first? Allison?
What would you like us to start with first, Mayor? Would you like us to start with the asset allocation or the quarterly performance review?
Well, I feel like the asset allocation is a big discussion. Maybe what do you all think? Should we do the quarterly review first and get it done? I'm seeing yeses, so,
I think it will help inform the asset allocation.
yes. So let's do that first.
Okay.
Welcome.
Thank you.
I will start sharing my screen. And you should have received a copy of the book over the weekend. But as a snapshot, as of June 30th, 2026, The return-seeking portfolio had a market value of $38,714,266, and then the liability-defeasing portfolio had a market value of $4.3 million, bringing the total city employee pension fund up to $43.0 million as of June 30th. You could see that there was a pretty significant increase in market value quarter over quarter. As of March 31st, the market value was $40.6 million. The overall allocation has not been changed much. As you can see here, we have a 60-40 split for the return-seeking portfolio. When you basically isolate the return-seeking portfolio, it's right now, as of June 30th, 38.9% in fixed income, 39.7% in domestic equity, and then 21.1% in international equity. This is now a little bit stale data, but as of the last actuarial report, as of June 30th of 2025, you can see that the pension fund is overfunded by more than sevenfold. So there is more than ample funds in order to pay the pensioners, as well as increases that you just approved, like you did earlier. Diving into the numbers, the return-seeking portfolio increased in market value by $3,188,882. That was a return just for the second quarter, so from April 1st to June 30th, of 8.97%. The benchmark was a high hurdle to overcome, and that was 9.25%. The liability defeasing portfolio, because of a gradual increase in rates that offset the income that was spun off from the portfolio. So the change in market value was very minimal, only at $23,414. And then most of your benefits were paid during this particular quarter, with $740,198 coming out of the account. One small tactical change that was made in May, we removed the tactical overweight to U.S. small cap equities and then underweight it to fixed income securities. Over the last 12 months, the return-seeking portfolio increased in market value by $5 million. That represents a return of 14.92%. The benchmark, meanwhile, had a return of 16.01, so we were underperforming the benchmark by 109 basis points. The combined overall portfolio was 13.48% when you include both the return-seeking portfolio and the liability-defeasing portfolio in its aggregate. So very, very impressive numbers, double-digit returns after two other solid years of returns in 23 and 24.
25.
And 25, yeah, sorry. So trailing returns, if you look over the last 3 years, the annualized total return over the last 3 years was 12.90%. That is not a cumulative return. That is a return per annum. So it's like you saw essentially over almost a 40% increase in the market value of the return-seeking portfolio over the last 3 years. Some of the things that we would like to talk about is U.S. growth continues to remain resilient. AI is just continuing to be a dominant theme in the markets. Last year, when we were talking about artificial intelligence, we were really focused on the Magnificent Seven. Those companies were some of the first movers in the industry, and they were sort of being viewed as the ones that are going to be able to profit from it. This year, if you look a little bit more deeper, some of the stocks such as Meta, Google, they have been a little bit more lackluster and have taken a back seat to some other AI companies. So when you are diving into the details, semiconductors have had a tremendous run in 2026. This has helped the small cap stocks to actually show very, very impressive returns. In addition, memory stocks have also done quite well. So AI continues to be top of focus. However, the companies that are basically driving stock market returns have had a rotation from those large cap names that we've seen before to some smaller cap names that are basically supplying the chips and the memory for those investments in infrastructure. The Federal Reserve, we saw a notable change. Jerome Powell was replaced by Kevin Warsh as the chairperson of the Federal Reserve. At Kevin Warsh's first meeting and throughout the first half of 2026, the Federal Reserve left rates unchanged at 3.5 to 3.75. And one of the things that we are looking forward to is seeing how Kevin Warsh basically changes the communication protocol of the Federal Reserve. He is on record basically thinking that the prior chairperson was maybe a little bit too communicative on future monetary policy. And I think he's going to make some changes where there's going to be less forward guidance in what the Federal Reserve is thinking. There is a meeting that started today and will conclude tomorrow. Most people expect the Federal Reserve to remain on hold at 3.5 to 3.75, but there is growing sentiment that the markets think that maybe the Federal Reserve needs to raise rates, which is a about face from the beginning of the year because of combating inflation. And third, Treasury yields have been quite volatile, especially since February 28th, when the U.S. and Israel attacked Iran. That has put pressures on inflation, which has then also caused the likelihood of a more hawkish Fed, and if the interest rates have climbed a little bit higher. So going on some of the themes, we were making great progress on the inflation front. And then, as I mentioned, on February 28th, U.S. attacked Iran, and Iran retaliated by shutting down the Strait of Hormuz, which has basically resulted in oil prices escalating quite dramatically. Through May of 2026, you can see here, the consumer price index has increased by a year-over-year rate of 4.2%, and core CPI increased by 2.9%. Both, as you can see, are significant jumps from the trend that we were seeing prior to the conflict with Iran. The June report showed some improvement. If you recall, there was a temporary ceasefire that resulted in the CPI and core CPI numbers coming back a little bit lower. And then, of course, over the last 2 weeks, we've seen renewed hostilities, and we're seeing gas prices rise once again. Talking about the Strait of Hormuz, the chart up in the upper half shows the traffic that we saw prior to the conflict. As you can see, there was essentially about 100 to 150 outbound shipments through the strait prior to the conflict. And for the last several months, essentially traffic has been a standstill. You're not going to want to basically drive a cargo ship that can't avoid mines that are throughout the sea. And if they get too close to the shore, they might be attacked by drones from Iran. And then there was also a basically a blockade by the U.S. of any Iranian ships. So essentially traffic came to a halt. When there was a memorandum, you could see that there was a small uptick in traffic. This definitely provides some relief on oil prices, which you can see in the bottom half of the page. Oil prices escalated quite dramatically in the first 6 weeks of the conflict, but then they've sort of tapered off more recently. In the U.S., the labor market remains robust. The U.S. unemployment rate improved from a level of about 4.6% in November of 2025 to 4.2% in June. Expectations is that we're going to have an unemployment rate remaining at current levels for the remaining part of 2026. But I think what is becoming a little more concerning is the impact of inflation on the everyday consumer. On the right-hand side, the light blue line represents real personal income, while the dark blue line represents real personal spending. In 23, you can see incomes actually outpacing the pace of spending, which means that the people are feeling, okay, they have money in order to pay for their everyday goods and services. However, it reversed, and now the gap is quite wide. I think as you talk to friends and neighbors, everyone's talking about the rising cost of goods and services, and you can't really open up any mail without seeing prices higher. Everyday things such as electricity, trash, are seeing increases in prices. And that is definitely going to be a hamper on definitely the lower half of the population, those that are generating half the income of the United States. Looking forward, as I mentioned, we had a change in leadership in May. Kevin Warsh took over as chairperson. At his first meeting, the Federal Reserve voted unanimously to keep rates unchanged. However, his tone is a little bit more hawkish, meaning he's a little bit more inclined to see interest rates increase, at least in the current interest rate environment where inflation is running a little rampant. So we've seen fixed income returns kind of be hampered because of the rise in interest rates. Looking longer term, this is a very infamous dot plot. Each board member basically is able to put what they think the federal funds target rate ought to be at the end of the calendar year. I wouldn't be surprised that Kevin Warsh changes this communication protocol and this dot plot will be gone by the end of the year. In fact, at his first meeting, he refused to put a dot on the chart. So that was a very noble change in policy. It's like beforehand, it's like we were always trying to guess. It's like each dot looks exactly the same, but people were trying to guess, okay, we care most about Jerome Powell. It's like which dot represents his point of view. And the new chairperson, Kevin Warsh, basically said, no, I'm not putting a dot on the plot. So that's just going to be something that evolves on communication. And I think in the past, Jerome Powell wanted to keep interest rates lower, and he felt that by over communicating to the market, that basically provided greater certainty and kept interest rates lower. So as opposed to letting the markets dictate itself things. One thing that I think is quite interesting is looking at the strength of the U.S. economy. Over the last 4 quarters, we've seen growth kind of jump around. During the second quarter of 25, we saw growth at 3.8%. During the third quarter of 25 at 4.4%. The fourth quarter was much weaker at an increase of only 0.5%, and then the first quarter was 2.1%. How this chart is quite different is that we put tech investments as an underlying overlay on this chart, which is represented by the blue bars. Tech investments have come in quite strongly over the last 5 quarters. You're probably hearing on an everyday basis where it's like, okay, one of the big giants, I think NVIDIA yesterday announced a $250 billion investment in OpenAI. These investments are actually spurring economic growth in the US. And if it wasn't for these tech investments, there is definitely concern on whether or not the U.S. economy is growing at the same pace. It's like there would be a significant detraction if these tech investments were not occurring today, as you can see with these blue bars. And then I'm going to turn it over very shortly to Allison, but here are the returns for the quarter as well as year to date. Just a couple of notable things up in the top with domestic equities. For a long period of time, the S&P 500 was the leader. It was the Mag 7. But for the quarter, you could see the S&P 500 increasing by a return of 15.2%. But the Russell 2000, which is essentially some of the smaller companies in the U.S. space, had a return of 21.49%. Over the course of the last year, the Russell 2000 had extremely strong returns, increasing by nearly 41%. In the international space, international equities with more developed nations actually trailed the US markets, but emerging markets outpaced with a return of 24% for the quarter and then 43% for the last 12 months. Fixed income securities, because that gradual increase in rates, those returns are quite depressed. Year to date, they were both below 1%, only 0.62% for the ag. And for global bonds, they actually generate a negative return of 0.21%. And then high yields had a little bit better of a year, but not by much, with year-to-date returns of 1.89%. Allison?
Yes, a couple additional comments. Thank you, Dave, regarding the markets. With respect to the Russell 2000, which Dave mentioned had a stellar quarter for small caps in the equity markets, we haven't seen this return since a quarter past COVID, when the Russell 2000 or small caps returned about 14%. So that's significant. And then with respect to the international equity markets, the driving force really, if on that ACWI ex-US, because we know that component of emerging markets is included in the ACWI ex-US, not in the EFI. The MSCI EFI is just developed markets. The emerging markets, we did see a change in the command of countries in the emerging markets. So we always talked about China, China, China. Well, China has dropped to number 3, and taking the first 2 slots would be Taiwan and South Korea, in aggregate representing almost 60% of the index. Why is that? Going back to Dave's comments regarding semiconductor and semiconductor equipment. Really stellar performance in that sector space, in the non-US, and really residing in emerging markets. And then one other, I was reading through the minutes from the committee from our last call, and there was an indication or a question regarding returns for the fixed income market, and looking at, which we discussed before, incorporating high yield as a separate fixed income sleeve in the portfolio, only small, but putting it back in the portfolio where it was before as part of the aggregate in the core fixed income portion of the portfolio. If you look at the return under fixed income for the Bloomberg aggregate across the quarter and all the way to the 5-year number, and we do have in subsequent pages it longer term out to 10-year, I believe, and compare that to the high yield return, you can see the significant outperformance in the high yield. Now, albeit we would never have 100% of your core exposure in high yield, because there are risk measures in that with interest rates, but we do, and it has added value in the portfolio when we had it in the portfolio incorporated in your fixed income exposure. And then lastly, listed real assets. Just take a look at the returns for the real estate investment trusts and your core infrastructure on the last 2 lines of this particular table. This is what we are talking about with the committee before, our discussion around diversification, lack of correlation with your traditional asset classes, i.e. domestic equity and international equity. You can see the difference in returns, particularly for these 2 components, but it's all not, it's all not, sweet cream and strawberries, because, you do look at that 5-year number and you see the NAREIT at almost 4% and the infrastructure at 8%. So what it does offer is that diversification on the portfolio. Any questions before I move forward to talk a little bit about equities before we talk about the portfolio? Because I know that's really where our discussion needs to be today.
Mm-hmm. Does anyone have a question at this point? Doesn't look like it,
Okay.
Allison, so thank you.
Thank you, Mayor. As you turn to 18, and I'll be quick on a couple of these slides I wanted to share with you. While Dave really gave a great backdrop to the economy and the market movements, I thought some different perspectives, particularly when it comes to the equity markets, that's a major portion of your portfolio, we really need to take a look at, and what our investment committee is considering from, the investment standpoint, near term, long term. I like this chart because I think it shows you from the beginning of the crisis in Iran to the close of the second quarter. Just take a look at the equity markets. and the drive in the equity markets, your domestic equity on the left and your international equity on the right. Despite these heightened geopolitical tensions, the markets demonstrated really true resilience during this period. On the bottom, you saw that peak in crude oil, and then it kind of leveled off. And the same in the treasury yield, where yes, a bit higher, but somewhat not as significant as we anticipated. Investors went back into those risky assets. As you turn to the next slide, can those equity returns continue the way they have from the past 3 years and now into 2026 with those robust returns? Slide 18 is just shows you the earnings environment for the S&P 500, your domestic equity. It remains very constructive from an analyst perspective. If you look at the light blue line versus the, how do I say, the not navy, but traditional blue line above it, the additional line above those light blue lines shows where analysts came in and reevaluated their estimates. They increased their estimate of those earnings. So that is very positive for the markets and positive for investors. You know, in light of what we're going through with respect to the geopolitical tensions and inflation on the horizon. As you turn to 20, Dave already indicated that the market is broadening out, and this is just an example of that. That Mag 7 very concentrated in our US equity market. You see the dispersion now. You see the dispersion as it relates to returns. They're not all moving in the same correlated fashion and leaving the remaining 493 in the dust. We're really seeing a broadening of the market. That's good. If you look at earnings growth estimates for Mag 7 versus the 493, you're seeing an uptick in the 493. Yeah, it's pretty robust. It's good for the Mag 7. Not going to say it's not, but it's not growing at the rate it has in the past. As you move to 21, looking at the international equity markets, again, the revision of upward earnings, more constructive markets. They are anticipating analysts overseas as well as in the US. Any questions? I'm going to move to 22, and then we're going to talk about the portfolio. Bringing all of this together, what Dave had talked about as far as it relates to various economic factors. There's still a lot of moving pieces. Well, we still have a very resilient, stable consumer. There are cracks. Dave had mentioned that investors, consumers are dipping into their savings, are using lines of credit and credit cards, moving away from the essentials, moving to the essentials, away from their experience spending. We still have that K-shaped economy. That is a concern. We also have inflation as a concern, but the labor markets themselves have remained very stable. We still are in this low hire, low fire. We did have job claimless rates come in last week, lower than anticipated, which is a good sign for the markets. On the flip side, the negative, the geopolitical, we're going to still remain in that close orange to red territory. It seems like every day there is, with a new tweet or something changes and it's impacting the market. The neutral is with remaining to Fed policy and the uncertainty there as we look at core inflation and measure and monitor core inflation. As you move to the next slide, there's just one area I want to talk about on slide 23, and was not the corporate fundamentals. Corporate fundamentals still remain strong. You do see that in the analyst expectations or reassessment of earnings growth moving forward being revised upward, as well as you see valuations. Valuations, because we've seen the growth in the equities, you're seeing valuations get a bit risky and expensive. So what does that mean for our investment committee as we position the portfolio? If you move to the next slide, Dave, please. We're in that neutral position, and you'll probably say, Allison, you've told us this before, and very different from 2020, where we made so many significant changes to the portfolio. We've taken that, as Dave said, that overweight for small cap. We did well on that overweight. It was small added value to the portfolio, but it got a little bit out of hand. They moved it back to your balance, back to your strategic weights, and use that money, put it back into your fixed income so you're aligned with strategic weights. We're calling this a balanced risk approach because in light of what's going on behind the scenes, we want to preserve that equity performance in the portfolio. We don't want to take too much risk in the portfolio at this point, particularly overweighting equities, just because of the increased volatility and the uncertainty in the market environment. So if we move to performance, I'm going to ask you to go to
I'm
34.
off. I don't know if it says, looks like something went wrong. We're trying to get you back into the meeting.
Oh, can you not hear me?
I do.
I can
Dave,
hear
can
you, Allison.
Okay. I'm going to move
I
right
mean,
to performance
Excel?
on 34.
Oh,
We
no.
did cover the performance
Oh, here.
here on
Linda,
the
you're
quarterly
not
market
muted.
summary. Okay, 34, Dave.
Okay, 34.
We're
Did
going to
Linda
go
have to
right
leave? I think she said that she had to drop off at a point
11:15.
in time.
Okay, so I'm coming right to the performance. So yes, we underperformed for the quarter. Yes, we did underperform for the year to date. And I know this has been an angst with the committee, the underperformance. And yeah, we're not happy with the underperformance, but we have really taken a more conservative approach to the portfolio as mentioned. If we're going to stay neutral weighted to the portfolio, we're relying on our active managers to outperform because we're staying with your strategic weights. Indexes, your ETFs, your passive exposure, that performance will be in line with that respective benchmark. In the active, that's not necessarily the case. And so we're relying those active managers outperform. We do have some active managers that are going to outperform when some underperform. And in the long run, we hope that we will be and anticipate to be outperforming the respective benchmark. The international markets themselves, 70% of active international managers for this quarter and year to date underperformed the benchmark. It is somewhat a concentrated market, and it's really shifted with the semiconductor and semiconductor equipment. Not making a rationale for it for this quarter, because as a committee, you look at that long-term performance. And in long-term performance, we haven't chin the bar on those various time periods. And I know that's a conversation we've had with the committee before in talking about the asset allocation. I do believe that looking at where this portfolio and the fact we move money over into the risk portfolio, this particular risk-seeking portfolio, being able to generate a stronger return versus in the liability portfolio was an excellent decision on your part, the committee, moving it here, albeit underperforming the benchmark, but really a strong delivery in absolute return for the portfolio. I'm going to stop there to take any questions from the committee because we've had conversations around this before and we continue to.
I believe Linda is back on, Mayor, excuse me. I believe Mayor Gorton is back on the call, so.
Okay.
I'm not sure what happened. We all just got kicked off.
I know,
Apologize.
everybody just went whoosh. So at least we've got a quorum back again. I'm not
Dave, do you want
sure.
to pull the book up?
Sure.
Okay.
Were there questions? Oh, there's Mayor Gorton.
There she is.
There she is. Now,
What, was I the only one that got booted out?
It was just you, Mayor. No.
I figured. Oh, good heavens. Well, anyway, where are we?
I
Allison
stopped
just asked
to
about
review,
questions.
Yeah, questions from the committee or comments with respect to the portfolio. Okay. When we move it to the positioning of the portfolio on the forthcoming pages. You know what, Dave, you incorporated a slide in this book, and I probably need to address it with the committee so they understand what it's illustrating, which is on page 33, the previous page. This particular chart or table illustrates the the managers in the respective portfolio in the 3 asset classes. Currently, the portfolio has exposure to domestic equity, international equity, and fixed income. Each of these components, the percentages should add up to 100%. So it's showing you the percentage of that portfolio with that respective investment or fund for March and the change in June. And the change could be a combination of reasons. It could be we rebalanced to increase that exposure and took a tactical or strategic overweight. It could be market appreciation of that position, or it also could be we added that position in the portfolio. We have added a U.S. equity manager in the portfolio. Lazard is an enhanced equity manager. I would like an enhanced between a hybrid of passive and active. They take their positioning in the portfolio as primarily passive to respective benchmark, and they make small overweights and underweights to specific constituents in the index. So you're going to have 100% exposure to the respective benchmark, but you're going to be overweight or underweight slightly each of those constituents. That was added to the portfolio in the U.S. equity side of the portfolio. We also in international, if you see the orange spots, we trimmed back on your passive Schwab exposure, adding it to Lazard. And then if you look down to the international, or I'm sorry, to the last line item, that small cap iShares Russell 2000, that was the overweight we put in the portfolio, as you know, and then we removed it during the second quarter. So there's no exposure to that. And then if you look at the international equity, we removed Aristotle International Equity for performance reasons in the portfolio, and then redeployed that exposure into the passive Schwab. Let me make a point about the Schwab passive exposure in the portfolio. If you look to the next page, go to the next page, please, Dave. And I say this because it may come up. I know that many of you look at the underlying returns for the respective managers. We utilize the Schwab International Developed Market and the emerging market for Schwab. Why? There's so many index providers out there. But we select our passive exposure based upon the exposure of that, which is really the benchmark that they use, as well as the cost, the transaction costs, and how the job that they do on rebalancing, because you do, the benchmarks reconstitute themselves. So there are constituents in the benchmark that are changing. We like Schwab because of the efficiency. We like Schwab because of the cost. It's very cheap. But Schwab, when they measure their portfolios, they bench it against the FTSE benchmark. They don't use the MSCI ACWI, MSCI, the Morgan Stanley indices, which we use for international. So the question is, well, why aren't you using the FTSE index? It's very expensive, by the way, and it's not the industry standard. So when you look at that return for the Schwab International and the Schwab Emerging Markets, you look at that return just for the quarter and you're like, gosh, Allison, that's way off. I thought this is passive exposure and it should match the benchmark. Well, the reason it doesn't match is FTSE puts South Korea in a developed market. So when South Korea, as we all know, has been driving this market on the technology side, the semiconductor side, very strong performance. You're not going to pick it up in that emerging market exposure in your passive. South Korea is landing in your developed markets. So the two of them together even that out, but I just wanted to make that point to you. Let me stop there, because passive in a market cycle, in a year cycle, should be spot on to the respective benchmark.
Questions? I do, just to interject, I think we will lose our quorum at 11:15. So I know of at least 1, 2, 3 of our members who will be gone. So, with all this said, what are your thoughts or questions? Anybody? Am I out again?
We can hear
Okay,
you.
I'm still in.
No, you're
Yeah.
in.
Dave, I thought I
You're
was
in.
booted
Yeah.
again.
We just we don't have a lot to say, I guess.
No, I don't think
Okay.
so.
Do you want me to move it to the asset allocation?
I think we need to. What do y'all
Okay.
think?
Yes.
I don't want to, I don't want to cut,
Well,
if
I
there's
know,
follow-up discussion or questions, absolutely,
Right.
send Dave and myself an email. I think that it is what it is for the performance, so,
well, I know that Commissioner Hensley has to leave in about 2 minutes.
okay.
And then Councilmember Baxter, are you still here or did she already leave? And I have to leave at 11:15, so I think that'll lose our quorum, Samantha, right?
That's correct.
Yep,
Okay.
so let's go right on.
Okay. Okay. I just lost. There you are. Okay. Okay. Can everyone see my screen?
Mhm.
Okay. Be very quick. First column, this is just a revisit. The first column is the current asset allocation for the Lexington Fayette portfolio. The second column is the 60-40 model, we call it, and it includes high yield as an exposure in your fixed income. And in addition, it also includes listed real assets, which we discussed on the June call. And the listed real assets, that 6%, comes from a rebalance in the equity portion. So the equity portion will move down to 54, listed real assets at 6, fixed income would remain at 40%, but we would carve out 3% from that 40 to high yield. There's 3 scenarios we put together here. The first scenario is where you currently are. You're in a 60-40 portfolio using our multi-manager series trust funds. Those are sub-advised funds. We don't manage the underlying assets. We hire those underlying managers for the respective asset classes, U.S. equity, non-U.S. equity, and fixed income. That expense ratio currently is 49 basis points. This was run from June, so it always would change depending upon the managers that we hire within those portfolios. Something for MMST to be aware of, if you look at that footnote underneath, because these are sub-advised funds and under the First American Fund name or under U.S. Bancorp's name, U.S. Bancorp actually receives a credit on that particular, a fee on that particular fund we established. We don't keep that fee. We revert it and send it back to you, the client. And it comes in your invoice. So every time you receive an invoice from PFM Asset Management, you will see a credit in that invoice. That credit represents the operating fees and the operating expense for this fund. So you are paying 49 basis points, but annually you receive back between 13 and 18 basis points from this fee. The second option, and just anyone interject as I go through this because I know it's time constraint. The second is let's carve out that portion, 6% to listed real assets. And let's take that 3% and move it to 3% out of your fixed income and add a high yield exposure. How does that change my portfolio and take all of our fixed domestic equity and international equity and move it to passive, all index exposure? How does that look from a fee standpoint? Fee standpoint estimated is 28 basis points. But in the fixed income, we still have that First American Fund, the multi-manager series trust fund, which we do every time you get your invoice, you'd receive a credit back for that. And that for that fund runs around 9 to 12 basis points is what you receive back for having the multi-manager series trust fund and fixed income. So if you look at that fee of 52 basis points, you can take about 12 basis points off of that fee, and that's what you're actually paying for this fund. And then the third scenario is we want passive. We don't want the market risk on the equity side. We want to move besides the domestic equity and the international equity to passive exposure. We want to use that of the listed real assets in a passive approach as well. How does that look for fees? And the way we adjusted it is we just moved the listed real assets to incorporate passive index strategies for that exposure, and that moves your fee down to 25 basis points. We still have the multi-manager series trust fund and the fixed income portion of your portfolio. We strongly advise staying in active for fixed income just because of that broad diversification and sector exposure. If you look back at the returns generated from this fund, it has performed well. We don't propose moving a fixed income into a passive exposure because then you're going to be focused on all treasuries, and that has its own risk inherent as well. So let me stop there and take any questions from the committee.
All
Or any
right.
comments?
Yes. All right. You've brought us 3 different scenarios. Thank you. And what are your questions or comments, board members? Let me ask first if Erin has any, since she has to leave really soon.
Yes.
Not
I
to
don't have
put you
any
on the
questions or
spot.
comments, but I will go back and watch the remainder of the video. So thanks so much, Samantha, for recording for us.
Okay, very good.
Thank you.
All right. I think we had Dave and Susan.
Susan, you can go first if you want.
Well, actually, Erin's opinion is what I was wanting to catch before she had to go off and to the next meeting. So I'm fine with listening to the rest of the conversation. So go ahead, Councilmember.
Thank you. Yeah, I think for us, one thing we probably would like to see, or at least I would like to see, is probably the performance of those different things against their benchmarks. I personally think passive is fine, and it seems like you have it seems like you, instead of having all that, you showed us a slide that for each one of these sections you have a 10 different things that you're doing for equities, and 10 different things you're doing for fixed income. This seems like a much simpler approach. And I would like to see the comparison of those things over that same time period compared to us. Does that make sense?
Yeah, well, we can't back test the portfolio if that's what you're asking. What we can show is we can show the performance of the funds we're proposing versus their respective benchmarks.
Yeah, I mean, but
individually.
But each one of those, the Vanguard REIT, for instance, it'll give you 10 years of its own.
Yeah.
It'll give you the same things. Yeah, you can't take our portfolio necessarily, but you can at least compare the returns of that versus what we've done actively for 10 years. You should be able to. You should be able to. Like if I go and look at a Vanguard REIT right now on Vanguard's website,
yeah, they'll give me their sheet.
They'll give me their fact sheet of, with a 10-year thing. I think that would be helpful to this.
Yes, absolutely.
Yeah.
Yes.
You know
individually,
what I mean?
yes. Okay.
Yeah, I think that would be helpful to at least understand. And then I mean, this is a simpler approach, and I'm generally fine with actually having a 6% in something that is slightly more volatile. But I do think in general, I feel like index funds are a little bit, they're just simpler. And then They are what they are. And I can't tell you, I still think you're just even in the last quarter, you're 25 points, you're 25 basis points off the results from last quarter. So it's the way I read at least that first slide that you gave us. So
Yeah.
Okay.
It has been, if you look at other pension plans, you'll see that there's a majority of international equity managers have really suffered. And I think in the most
Yeah.
recent period, but looking long term where the portfolio from the construction standpoint and how the committee feels and what we're trying to achieve, I think one area we're trying to achieve is more of a comfortability with the performance on the equity side, which would allow, which I believe, being in the passive exposure, there is more comfort there in the passive exposure that you'll achieve market return.
Yeah, that's
And
basically it.
yeah, and then the incorporation of the infrastructure and the REITs allows for that diversification.
Yeah,
And
I'm
also
okay.
allows to help with that volatility moving forward. And
Yeah.
how do you feel about, the committee feels about the high yield in the portfolio? While we did have high yield in the portfolio up until September 2025, at that time it was removed out of the portfolio because the investment team decided to be really aligned more with the benchmark, and high yield is not in the Bloomberg aggregate benchmark.
Thank you.
Dave, are you looking for any specific time periods, like trailing 1, 3, 5, and 10? Or
Yeah, I would
Yeah.
just, it'd be pretty simple to just do it. Yeah, the exact
Yeah.
way that you've done that chart,
And just show the
that one
performance
chart,
of the
and
respective
just show the
benchmarks.
performance of those over that same period of time. And so it kind of becomes then, it's like, okay, guys, this is what we would have gotten.
Yep.
You know,
Okay.
or
Right.
whatever. All right.
It'll show the absolute return versus the benchmark. Yes. Mhm.
And I think that is a great suggestion, council member. It would help me personally, I know. And I also am grateful for the simplicity of what you brought us. So I'd be interested if there are other comments or questions.
I mean, my only other comment is that I appreciate this as well, but I would look towards my Commissioner of Finance, our Commissioner of Finance, for her knowledge and understanding and recommendations before any decisions made to make any changes. I would not feel good about making changes without hearing our, Commissioner of Finance's opinions. I think, to me, that I hold her in very high regard. So,
Well, with that, and we're close to breaking our quorum. With that, how about you bring back
Mhm.
those numbers that Councilmember Savigny asked for? I think that's a great idea, so we can see a little bit of a
Sure.
comparison.
Mhm.
Okay.
Yes.
And then we have
And-
this information again for the next time. I think that
we,
would give us
we will
good
get
info.
to you in the next week and a half, so you will have it
Yeah.
very
Mhm.
available. And if you
And
want
just-
to,
Just give it to us. Give us you made several, you basically gave us 2 or 3 options there, if I read to the
Yes.
2 or 3. So include all the ones that you gave us in groups. Okay.
Mhm. That,
Thank
I
you.
think that's a great idea. Now we don't meet until October. Is that okay with everybody? Because I think we're not in a great hurry, right? But that would be a time when we could make our decision with plenty of information. All right. Any other comments or questions, or I think we know what we're going to be doing in October, and the next meeting is the 27th. So that gives you plenty of time to bring us information and comparisons.
Mayor, I think Miss Summers is trying to speak.
Okay,
Miss Summers, can you get someone to unmute yourself? Unmute your.
a little button maybe at the top. it says Mike or,
I think there's someone there helping her, I think, so. Yeah, that's good.
can you,
In the upper right-hand corner, you should be able to turn off the mic.
in mine, it's right next to the camera icon. Is yours, is all of yours that way? I don't know if yours is or not, Miss Summers.
Samantha, is there a way on Teams that you can, since you're hosting the meeting? No?
I looked and I don't have that capability. I know I don't have an iPhone. I know that Charlene uses an iPhone if it's different.
Oh, okay.
Okay.
Any other
Uh,
suggestions for the iPhone?
It's definitely on Teams because the mic is X'd off. If you were muted on the iPhone itself, that would be an iPhone command, but how it's showing up on Teams, it's a Teams functionality.
Can I suggest that she either type something to the group at some point?
In the
Or-
chat?
Yeah. But I don't know if she can do that either.
It looks like maybe she's frozen.
Uh-oh. Oh,
There you are. You're unmuted now.
Yeah, we can hear you.
oh, hello.
You're back.
We hear you, Charlene.
Go ahead now.
Thank you.
Oh, yay. Did you have some thoughts about the discussion?
I wonder, when do you need a loss of a member to have a quorum?
In terms of when do we lose the quorum, I think we have to have 6. Is that correct, Samantha?
That's correct.
And so we have 1, 2, 3, 4, 5, 6 right now, and I'm about to leave, so that will break the quorum and we'll have to end. Does that answer your question?
Yes.
Okay. I think we're about finished anyway. All right, thank you, Ms. Summers. And is there anything else? I think we know what we're going to be doing in October. Anything else? All right. Thank you all very much, David, Allison. We appreciate you and board members. And our next meeting is October 27th, and I will entertain a motion to adjourn.
So moved.
Second.
Thank you. All those in favor say aye.
Aye.
Aye. Is anyone opposed? All right, we are adjourned. Thank you.